before we begin, it is once again important to have this disclaimer that whatever covered during this course will be only for educational purposes only. It does not constitute any financial advice, and you should, to take this as a learning experience. Okay. So the outline for today's webinar would be as such. First of all, we would do a quick recap of our CF Discovery Day 1. And moving on, we would go into fundamental analysis and a little bit more about technical analysis. Okay, after that, we will move on to understanding the risk involved in CFD trading. All right, after that, we'll also have a very simple illustration of a stock of a transaction made on stocks trading versus a transaction made on stock CFD trading. Okay, at the end, we will do a platform demonstration on MT5. Okay, so let's recap quickly on what was covered during our last session on last Thursday. So CFD, it stands for contract for difference. It is a derivative where its price is derived from an instrument that is underlying. Okay, so the underlying asset could be something like a stock, ETF, commodity, or indices. Okay, CFD is an agreement between both parties, between two parties to settle the difference in price between the opening price and the closing price of the contract. Okay, and there is no physical delivery of the underlying in CFD. You are just trading the price, and CFD is a leveraged product. It is traded on margin, and people would trade CFD in order to participate in the price movement without owning an underlying asset. Okay, so we also covered about some of the costs for trading CFD. It includes spread and also swap. Okay, so these are some of the reasons that people are trading CFD. First of all, it is the small barrier to entry. Secondly, you are able to trade both ways. You are able to long and short. There is no expiry date or risk of delivery for CFD. CFD is traded on zero commission. It helps us to achieve capital efficiency because you are able to open a large position with a relatively small amount of capital. So that means capital efficiency. And lastly, it is you are able to hedge your long-term position with CFD. Okay, so that is a quick summary of our quick recap of what was covered last week. So moving on to fundamental and technical analysis. Okay, so before you want to trade, right, like how do you determine what you're going to trade, when you're going to trade? So it comes down to analysis, which there are two main types, the fundamental and the technical analysis. Okay, so fundamental analysis basically help us to shape our investment decision based on macroeconomic down to microeconomic factors, to determine the intrinsic value of a company or any other assets like commodities, ETF, or indices. So basically, the goal of fundamental analysis is to help us assess if a particular asset is correctly valued. Okay, so let's say if a stock, you have done your fundamental analysis, you believe that the price that it is currently trading is undervalued, means it is trading at less than what it should be trading at. So therefore it is undervalued. Then you would make a buy decision on that stock. So on the opposite, if you believe that a stock is trading at a too high of a price relative to what it is actually worth, then you would make a call to sell. Okay, so that is fundamental analysis. So I spoke about, fundamental analysis. It can go from a macro perspective down to a micro perspective. So some of the macro factors that people look at is the state of the economy. So is the economy in general doing well? Are you in a bull or bear market? The outlook of a particular industry or sector. So let's say we have various teams like EV or ESG and all that. So you would do your fundamental analysis based on the outlook of this particular industry. Do you think it's going to grow? What is the prospect of this industry? Okay, so these are all very broad based. Okay, so coming down, we also have, you would look at global events like the COVID-19 pandemic and how they would affect the economic outlook. And also we have a monetary policy like the Fed interest rate decision or the tapering that's recently happening. Okay, so those are the macroeconomic factors. They're very broad and they basically cover the whole economy as a general body. Okay, so coming down to microeconomic. So these are more micro. Okay, so we are zooming down into the particular business, that particular stock that we want to invest in. Okay, so there are a few metrics, so I'm just naming a few out of a lot. First of all is the business model. Secondly, it is the management. You will look at a company's management or the founder. Has he got a good track record in running the business profitably and all that? Okay. You would also look at a company's competitive advantage. Does it have a patent to a certain product that it has exclusive rights to, therefore giving it, a competitive advantage in the long term? So that's one of the things that people look at. And also like company earnings, financial information, like they look at the financial statements, the balance sheet, and all that. Okay. Also, you look at the future growth prospects of the particular company. So basically, that is all that I have for fundamental analysis, because for this webinar series, we're talking about CFD, which technical analysis would play a more major part in it. Okay, so for technical analysis portion, I would be going in more detail. Okay, so basically technical analysis is actually the opposite of fundamental analysis. It basically disregards everything that's fundamental. They only look at the chart and solely the chart. Okay, so you can understand the market sentiments based on historical price movements. And using this historical price movements, you would forecast the future price movements, and therefore to help you determine what would be the entry or what would be the exit points. Okay, so this is really making the assumption that the history will tend to repeat itself. And most of the times it tends to. Okay, so that's the basis and the foundation of technical analysis. Okay, so when we talk about technical analysis, there are a few main concepts that we need to start with. First of all, we need to learn how to read a candlestick, understand the concept of support and resistance, and we need to learn about what is a channel, so therefore you can determine the trend, and also some of the patterns that would help us in our technical analysis. Okay, so let's look at this screenshot. So basically this is a candlestick chart. I think this is one of the more common ways of reading a chart. It is a candlestick chart. Apart from candlestick chart, we also have line chart and bar chart. But for today's purpose, we are going to cover deeper into candlestick chart. Okay, so candlestick chart, they are formed by things called the Japanese candlesticks. Okay, so it is called the Japanese candlesticks because I think it was invented by someone from Japan. So therefore it's named. Okay, so Japanese candlesticks, right, there are two types. The first type being a bullish candlestick, the second type being a bearish candlestick. Okay, so I think as the name suggests, a bullish candlestick, that means that price increase during this candlestick, and the opposite would apply for the bearish candlestick. Okay, so let's set the record straight. Candlestick, right, they can be set to various time frames. So you can set a 4-hourly chart, a daily chart, or a monthly chart. So let's talk about a daily chart now. So let's assume that we are pulling a daily chart. So every candlestick on the daily chart would represent the price movement of that asset during that day. Okay, so let me reiterate. On the daily chart, a candlestick summarizes the price movement during that day. Okay, so let's say you jump to a 1 hour chart. So one candlestick will represent the price movement of 1 hour. Okay, so I hope that is clear. So once that is clear, right, then we can go down to more details of the anatomy of this candlestick. So there are a few main parts of it. The first one is the body. Okay, you see the thick large block that's at the center. So that is actually a body of the candlestick. Okay, secondly, you have the upper wick, and thirdly, you have the lower wick. So what they actually mean, so let's look at the bullish candlestick first. So at the bottom of the candlestick body, that is the open price. At the very top of the upper wick, that is the high price. The lower peak, the lower bottom of the lower peak is the low price, and ultimately the upper part of the body is the closing price. Okay, so let me put into one sentence to summarize it clearly. So looking at this candlestick, right, you would know that during this day, the price actually opened at this opening price. Throughout the day, the price actually went as high as this place, and it also went as low as this lower wick. And eventually, at the end of that day, price actually closed higher at this level. So that makes it a bullish candlestick. Okay, so price, it went from here all the way up to here. But we know during the course of that day, the price did trade up to this point. Sorry, and it did trade up to this point, and it did trade down to the lower point. Okay, so let's look at the bearish candlestick. So basically, it is a mirror image, just that it is opposite. Okay, so you would open at this price up here, then you would, during the day, you would trade up to this point. You may trade as low as this point, but eventually you're closing below the opening price. Okay, so so basically the beauty of the Japanese candlestick, it really allows us to see so much information during the trading day just by looking at the candlestick. Okay, so I hope the explanation was detailed enough, and we can go on to the next portion. So now that we understand how to read a candlestick, it is also important to know that candlesticks are not meant to be used on its own. Okay, it is powerful when you combine a series of candlesticks and then to determine the price direction. Okay, so there are a few popular reversal candlestick patterns. So what it means, that what a reversal candlestick pattern means, that when you see such a pattern, it tends to mean that the price will reverse from its original course. Okay, we will cover a few popular types of candlestick. The first is the Doji. Okay, as you can see from here, right? During the trading day, it started here. It started at this body. It is very thin. During the trading day, it went up as high as this. It went down as low as here. But eventually, it closed at around the same price with the opening price. Okay, so this is a bullish candlestick sign. Okay, so in the bearish case, we have the gravestone doji. Okay, you open here, and during the trading time, you went up all the way up here because people buy, but eventually the buying power did not sustain, and people start to come in and sell. So the price then went all the way down here, and it closed even slightly lower than opening price. Okay, so let's we have an example here, which is a example of a long leg doji. Okay, you see that after a downtrend, when you see two of these two of the long leg doji, it tends to signal a reversal to the upside. So this is a very good example right here. Okay, so basically what it means, it is the indecision of the buyers and the sellers come to this point. They cannot decide. So after a downtrend, some long leg doji will tend to hint a reversal to the upside. Okay, and also the next one, the popular ones, would be the engulfing candles. The first is a bullish engulfing candles, and this normally happens after a series of downward price movements. And when you see this, right, there's this bearish candlestick. After it closed down low, the next candlestick, it came back so strong that it just literally engulfed the whole previous bearish candlestick. So from here, what we can see is that the buying pressure, or the buying force, is really strong lah, and it engulfs the previous the bearish candlestick. Okay, and this is also another reversal pattern for candlesticks. Okay, the next one, the opposite, would be a bearish engulfing candlestick lah. Okay, so another one would be a hammer. So hammer normally happens after a series of downward price movements. So when you see a few of all these, you're getting a stronger validation that prices will therefore bounce higher. Okay, so here is another example of a hammer. And the opposite of a hammer is something called a hanging man. It normally happens after a series of upward movements. You see this hammer, because basically, yeah, you see that the price went all the way down here. It did go up, but the buying force, you see, so we have this buying momentum here, right? So coming to this point, the prices actually dipped down here, and the buying force did try to come in and buy. It went up, but eventually it still fails to close higher than the opening price. So the sellers still got the upper hand, and therefore this normally signals a downtrend from the previous uptrend. Okay, so basically this is just a few examples of some popular Japanese candlestick patterns lah. Okay, so yeah, these are a few popular ones. So moving on, in technical analysis, it is also very important to learn about trends. And people always say, you know, the trend is your friend. When you want to trade, you make sure that you have identified the trend before placing your trade. And you should always, you know, place your trade following the trend. Okay, so there are a few types of trends. Basically, prices can only move in an uptrend, which is uptrend here, and the price can also move in a downtrend. And when the price don't move in neither up or down, they move in a sideways trend. Okay, so these are the three main type of trends in technical analysis. And how do you identify a trend? Okay, so coming to this part, it is about drawing lines. So in an uptrend, you would aim to find a series of higher highs and higher lows. Okay, so in this case, you can see you identify a few lows, point a low, say one low, two low, three low, and four lows. Then you will try to draw a line along this. You try to connect them. So once you're able to connect for at least 2 to 3 low points in a line, then you can identify a trend line. Okay, so this is a bottom support trend line. To complete the channel, which makes up of two lines, you would also draw a upper resistance line, okay, which is you connect a series of high highs together. All right, so for a downtrend, you would do the same. You would try to connect a few lower highs and a few lower lows. Okay, so once you can get two lines like that, two lines that are parallel to each other, you have a channel. Okay, so in technical analysis also, you would always hear people talk about support and resistance. It is an extremely important concept, you know, to understand. So basically, support and resistance, they mean psychological levels where buyers and sellers would react. Okay, so looking at this illustration, when price come up to this part, it is met with this resistance, and it got bounced back down here. When it comes to this line, right, it is a support, and price couldn't penetrate further. It can't go lower, then therefore it bounces back up. Okay, so let's first talk about resistance lah. Actually, like in layman terms, it is really just an imaginary ceiling that prices just cannot penetrate above. When the price reach this resistance level, right, the selling interest would come in and they would send the price lower. Okay, so a support is really just an imaginary floor where the price simply just couldn't go below. Okay, so when the price hits this support level, right, buyers would come in and try to buy the dip. Okay, because you know, for the buyers, they think that coming to this price, it is really worth a buy. Then they would come in. The more buying power it comes, then the price would be pumped up lah from the support level. Okay, so that is the concept of resistance and support. They are just imaginary levels where, you know, price either couldn't go below or price either couldn't go above. So, you know, what happens when the price hits this support or resistance level? There are two ways. There are two possible ways that the prices can react. The first is that they conform to the support and resistance. So let's look at the example here. The prices went all the way up here, right? Then it is met with a resistance. So it conforms to it. Okay, it hits its head, come back down. When it come down here, it is met with a support. So it is conforming to the support, it bounced back up. So this continues, it keeps conforming to the support and resistance until it doesn't. So the second, the reaction when price hits support resistance is that it violates the level. So at this part, you can see that the price, it just broke the support level. Okay, so prices can either react in two ways when they meet support or resistance. They either conform to it or they break it. Okay, and this right actually perfectly segues into the next portion, which we talk about some chart patterns. Okay, so let's first talk about chart patterns. You see, we have so these are some common chart patterns lah. Okay, we have the rising wedge and the falling wedge. So how do you determine a rising wedge? It is by connecting a series of higher highs. You can see here high, higher high, higher high. Then you draw a line, and then you try to find a series of higher lows. Then you draw a line. In the example that we covered just now, the two lines, they are parallel to each other. So that makes a rising channel or falling channel. Okay, but what happens when the two lines they are slowly converging to form a cone shape? So that is what we call a wedge. So if the trend is rising up, we call that a rising wedge. And when the trend is going down, while the two lines somehow are converging, we call it a falling wedge. Okay, so once I think this is like a beginner thing that we can learn when we just start to do technical analysis. And going down the road, these are actually extremely powerful or very insightful for us to predict a trend reversal. Okay, so rising wedge, right? It is actually a bearish reversal signal. So it means there's a high chance that after you see a rising wedge towards the end, until it breaks down from this support line, it tends to go lower. It tends to go low as where the formation started. So that is where there are set rules where for certain kind of certain kind of chart patterns, once certain level is broken, then you should set this technical target at a certain level. So all these are basically like textbook examples, like you can search them up online. There is abundance of all these. Okay, so once you have identified or once you have learned enough of all these chart patterns, you could effectively apply all these to the charts that you look at and try to identify what patterns are you looking at. Okay, so this is rising wedge. Okay, here's an example. After a falling wedge, right, you can see during the course of the falling wedge, prices conform to this support line and this resistance line. Price keeps conforming until it doesn't. So when it doesn't, right, that is what we call a breakout. A breakout from the upper resistance line. And for a falling wedge, typically once you break out, the technical target would be set at where the formation started. Okay, so that is falling wedge. And next we also have a head and shoulders. So basically it is also another reversal pattern. Now you see price, they keep going up. Then at the up, almost at the top, right, then you start to see like three peaks forming. The first and the third peak, they are almost equal in height, and the middle one being at the tallest. So that really looks something like the two shoulders and one head. So what this means is that the buying pressure simply just cannot sustain anymore. Coming to this point, the price tries to go up, but it fails to come down. So this went on for 3 times. And once the price breaks down from this neckline, it validates that the selling pressure is really just stronger than the buying pressure, and therefore the price will tend to slide after the price drops below this neckline. Okay, so the opposite of a head and shoulders is something called the inverse head and shoulder, where after a downtrend, when you can identify a inverse head and shoulder, once it completes, it tends to send the price up again. So they reverse the trend. Okay, so another example here, you see a downtrend right here, and you try to identify 3 peaks. Okay, the first one, the left shoulder, the head, and right shoulder. And one very important part is also the neckline, which is this line connecting all 3 peaks now. So normally after the break of this neckline right here, it signals that price, it's confirmed that price would go to the other direction, and you can place your trades accordingly lah. Okay. Another one is a double top and double bottom. They work fairly similar to the head and shoulders pattern, where it is a trend reversal signal. Okay, so I did try to give a crash course on technical analysis. We've covered on what is a candlestick, what are some popular candlestick patterns, and we did also cover some of the chart patterns that are common, but definitely the list is much longer than this. I'm just trying to show you a few of the more popular ones to get you started. Okay, so we also want to do a comparison, between fundamental and analysis. How are they different? So in a nutshell, right, the fundamental analysis is more of for longer term. So let's say if you want to invest in the stock market, the underlying stocks, so you'll be looking at fundamental analysis because it is long term. And the fundamental analysis determines the directional view, in the longer term. Okay, so it also helps you to answer like what do you want to buy and why do you want to buy. Okay, so technical analysis, on the other hand, it serves a different purpose. It is more for shorter term trading, like, CFD is more like a short-term trading thing. So that's why in this presentation, we did cover more on the technical analysis side. TA, it also helps you to identify, sorry, my slide just jumped here. So the TA, it helps you to determine what are the entry point, when to get in. You want to get in at a support level, and you want to get out at a resistance level. Okay, so basically technical analysis answer the question why. Okay, so I think we have a good overview of fundamental and technical analysis. We can then move on to the next portion of our presentation. It is understanding risk involved in CFD trading. Okay, so I think, let's be honest, like all of us know that CFD or leverage trading is risky. So everybody says it's risky, but how is it actually risky? Like, how is the calculation like? So in this next portion, we aim to address that, okay? Understanding the risk involved in CFD trading, in leverage trading. Okay, so bring it back to an example that we showed last week. So last week, I showed you guys for different kind of contracts, what would be the initial margin that you need to put in to start a position. Okay, so for those who didn't join us last week, so basically CFD is traded on margin, and margin for different kind of products or contracts, it varies. So for Forex, the margin is 5%, and for CFD, it varies also from 5% to 20%. So I did give a few examples. The first one being the Brent crude oil, the margin is 20%. Okay, so in order to open a contract that is for Brent crude oil, right, the contract size is it is 100 barrel. So whenever you want to start investing in a Brent crude oil, the minimum position that you can start is $7,400. Okay, assuming a unit price of $74. Okay, so to open a position that is as big as 7,400, you would only need to fork out 20% of that, which is $1,480. Okay, so you fork out 20% of the whole position while borrowing the remaining 80%. So that is what we mean by leverage trading. You outlay an initial capital of a fraction and you borrow the remaining portion of the position. Okay, you borrow money to trade. Okay, so let's move on to see, assuming you utilize all your initial capital to invest, to trade in this first example. Okay, let's talk about Amazon. So example that you have $700, that is all you have, and you want to place a trade. Okay, so with $700, you are able to open an Amazon share CFD position. So let's say, Amazon, it is trading at 3,500. So times one share, your position size for Amazon, it is 3,500. Okay, so your margin will be 20% of that, and it is 700, just nice. So we want to answer the question, how much can the Amazon price actually drop before I lose my initial capital? Okay, so our initial capital is $700. So we want to know how much can Amazon price drop before I lose my entire, investing capital. So let's say the price drops 20% to 2,800. My initial margin of 700 will be lost. Okay, so it kind of makes sense, like, you're putting in 20%. So the 20% of the contract size is your money. Let's say the full contract size depreciates by 20%. Your full initial margin would be gone. Okay, so this is the calculation of it. So a 20% decline in the position that you're holding actually result in a 100% decline in your initial margin, in your initial capital. Okay, so let me repeat that again. A 20% decline in the share that you invest in would result in a 100% loss of your initial margin. Okay, so that is actually the risk of CFD trading. So moving on to a next example, taking the Brent crude oil example. So also the same assumption, you invest all money that you have into one contract, which in this case, all of your initial capital is 1,480. Okay, 1,480. So how much money, or how much can the price drop before you lose this entire capital? It is the same. It only needs to drop to it only needs to drop from $74 per barrel to $59.20 per barrel for you to lose your entire $1,480. Okay, so later on when you try the trading platform, you may be confused at the beginning, but about this contract size, because when we say the minimum that you can invest in Brent crude oil is 100 barrels, but that's not to worry. On the trading platform, right, let's say if you key in 1, so this would mean that one contract equals to 100 barrels lah. So this is just for you to note, but in terms of the platform, we'll cover more on that later. Okay, so I think for S&P 500, it is the same concept lah. So it only needs to drop 5%. The S&P 500, let's say you're investing in it, it only needs to drop 5% for you to lose your entire initial margin. Okay, so leverage risk is real for this leverage trading, for CFD trading. So it is really a double-edged sword, and risk management is a must when it comes to this kind of trading, which I would, encourage you to join our third session, which happens next Thursday, where we will talk about risk management and how you can navigate through all this leverage risk. Okay, so coming on to another part, I think this portion is also very important. It illustrates you the concept of margin in the account that you trade in. Okay, so for this portion, I would urge you to pay a bit more attention. It is quite crucial understanding. Okay, so let's say in the beginning, you have just deposited $1,000. So on the platform, you would see that your balance is $1,000. Makes sense, right? Then there is also another component in your trading platform called the equity. So equity, it is the unrealized or floating balance of your trading account. Okay, so we have the balance and we have the equity. The difference is that the equity will be floating. So at this point, we've just deposited, there's no open trades. Okay, so it makes sense, the balance, the realized and the unrealized, they are the same. So that is the balance versus the equity. Okay, and also the margin. When you have just deposited $1,000, your free margin would be $1,000. What this means is that for this $1,000, right, you are free to use them as a margin. Okay, so you don't have any open positions. All the money you have in the trading account, you can use all that to put in as margin for various positions. You can put that's a very extreme scenario. You can put all this 1,000 into a single trade, which we highly don't recommend. Or you can also fraction this, like maybe out of this $1,000, you can take like $50 to initiate a position, another 100 to initiate another position. So that is the concept of it. Okay, so and the break-even point would be $1,000. You start with $1,000. As long as you're still at $1,000, you are break-even. Okay, so moving on, an example. Let's say you want to buy 2 Tesla shares CFD at $1,000 each. Okay, two Tesla shares with $1,000 each. Okay, so your position size would be $1,000 times 2. That makes a total of $2,000. Your whole position size is $2,000. So for a $2,000 position, how much initial margin do you have to fork up? The answer is $400. So how you get that is basically just times the notional value of the position times the 20% margin. You have $400 initial margin that you need to put up for that position. Okay, so let's look at equity. This is assuming that you just bought, so that means the price hasn't moved at all. It is still at $1,000, and there's some changes now to the margin. Okay, so previously we were saying like we have $1,000 free margin. That is all that you can use. So now that you have used $400 for this Tesla share position, right, your used margin would be $400 right now. Okay, so this portion, it is used. You cannot use it for anything else. Okay, it is locked there. So what is remaining is $600 of free margin. Okay, so this $600, you are free to play around with it to open other positions. Okay, so that is used margin and free margin. So let's assume that the price rises from $1,000 to $1,250. Okay, your current position size would grow from $2,000 to $2,500. Okay, so your position has grown. Initially it was only 2,000, now it's 2.5K. So your floating profit and loss would be $500, and so will your equity. Your equity, because I mentioned it is floating, right? So equity would also follow the floating P&L to increase to 1.5K. But right now, if you look at the account balance, it will still be 1,000, because right now you have not realized this profit and loss. It is still floating. Okay, so the balance will remain at $1,000. So let's look at the margin. Okay, your use margin, it is fixed. All right, intraday, it is fixed. Then your margin will follow the floating P&L to increase to $1,000 and 100. Okay, so this free margin has increased. You can initiate more positions with this. So this is a bullish case lah. Okay, so what about a bearish case? So let's assume if the price of Tesla CFD drops from 1,000 to 750. So your current position size would have shrunk from 2,000 to 1,500. So your floating P&L would be minus 500, and your equity, since it is floating, right? So naturally, it should also reduce to only 500. Okay, so let me recap. Equity is unrealized, it is floating, it keeps changing as long as you have a position open. So in this case, the floating P&L is at a negative of 500. So therefore, your equity would also reduce to only 500. Okay, so now let's look at the margin. The margin is $400, but your free margin is only reduced to $100. Okay, so you only, at this point, you only have $100 more to open other positions. Okay, and let's say, what if the price falls further from $1,000 to $700? It would mean that your position size would swell from $2,000 to 1.4K. Floating, minus 600. Equity, it would be minus 600 also. And at this point, you would realize that you have no more free margin, because your equity is exactly the same as your use margin. So whatever equity that you have right now, right, it is used in that same position already. Okay, so at this point, you would actually receive a margin call, because your equity is exactly the same as your margin. So this is kind of like you're going into the risky territory already. So normally we would issue a margin call via email for you to top up your funds, so that we can have more of a buffer in your trading account. Okay, so another part is also, what if the price keeps going lower? And if the price keeps going lower, right, you face the risk that your position will be auto liquidated. Okay, so this is assuming that the price or your whole contract really went from $2,000 to $1,000.50. Okay, so your floating P&L is really negative 950 already. And at this point, your equity is left with $50. Okay, so to recap a bit, at this point, your balance, it is still $1,000, because this is not realized yet. Okay, so forced liquidation will happen when your equity is less than 20% of your initial margin. Okay, the forced liquidation level, the threshold, is actually 20% of $400, which is $80. Okay, at this point, your equity is already lower than that threshold level of $80. Okay, so therefore your position will be auto cut, and your losses will be realized if you don't top up your account to have the more equity or more free margin level. Okay, so bringing back to the margin call that we mentioned just now, the purpose of a margin call is for you to top up your account to prevent this auto liquidation from happening, to prevent your losses from being realized. Okay, so after the forced liquidation, your losses would be realized, and you can look at the balance now. It is left with $50. You have realized the losses of 950, and so does the equity. Okay, so we also need to bear in mind that during a scenario like that, right, because the system or the company will be doing a forced liquidation for you, your final balance may not be as much as $50, because it may be sold or closed at a more unfavorable price that will give you more losses, even lower than a 20% of initial margin. So what we want to prevent is really to avoid coming to this stage where our position gets, auto liquidated. Okay, so that I hope that was clear enough for you to illustrate the magnitude of the profits and the losses you can make through leverage trading. Okay, but all this recording of this webinar will be sent to you after the webinar. So let's say if you miss certain part or you feel that you need to repeat it, you can feel free to watch back the webinar recording. Okay, so there are also some other risk, which is the liquidity risk, where there are not enough buying or selling volume in the market, so therefore it will result in a very huge spread. Okay, the price wouldn't be favorable when there is a very thin liquidity. Okay, and also there would be risk of trading suspension, because we mentioned that CFD, the price is derived from the underlying market. So let's say what happens when the underlying market actually suspends trading of a certain share. Therefore, we on the CFD side, we wouldn't receive any prices also. So when the underlying market receives a trading suspension, so will the CFD. So that is another risk. Okay, and there is also the risk of stale pricing, because there is a system to link the prices from the underlying market to the CFD trading platform. On rare occasions, there would be a mismatch in prices between the actual underlying market versus the prices that you see in the CFD trading platform. Okay, so there is a risk of stale pricing. And also the next one is really the market volatility, because sometimes when you want to place a pending order, so there are orders like, let's say it's $1,000 now. You want to set a buy order or sell order at a different level. So let's say when price reaches a certain level, the system will auto execute that trade for you. But at times when the market is highly volatile, the price could just skip through that price that you set, and the trade is made at a price that you wouldn't want, an unfavorable price. So that is another risk of the market volatility. And also there is this risk of share recall, because CFD, you are able to long and short. To short sell a certain contract, you would need to borrow from someone in the first place. Okay, so let's say when someone who borrows the share, they decide to take back the share, and therefore you would have to return the share that you short sold on a short notice, and that may not be at the best price that you want to return the share lah. Okay, so CFD also has this risk of the share recall. Okay, so moving on, we will do a simple illustration of a stock trade versus a stock CFD trade. Okay, so taking back the example of Tesla, we have the share CFD and we have the shares on the right column. Okay, so for the first example, let's just look at the share CFD. You buy Tesla share at $1,000, so the price would be the same. Okay, $1,000, $1,000 for each. So let's say you buy for the shares, you would incur a commission. So the commission is like 0.01% of the notional value, which is $10. But for share CFD, there is no commission. Okay, so you have bought it today. Let's say 5 days later, you decide to hold it for 5 days. So there is something in the share CFD that is called the holding cost. So basically, remember we said that to invest or to trade CFD, we are borrowing money to trade. So to borrow money, we also have to incur borrowing cost. So that would be considered into the swap. So to hold, for every day that you hold a share CFD position, you have to incur the financing cost. So that's what we call the swap. So in this case, the swap is like almost 50 cents, while the shares, the underlying shares, you would incur no holding cost. Okay, so 5 days later, you want to sell it at $1,200. And for the share CFD, you would incur no selling commission. And for the share CFD, you would incur another round of commission. Okay, so let's look on the profit and loss of this transaction between both. So for both the profit and loss, it is $200. Okay, because price went from 1,000 to 1.2K. And the cost that you would incur is also for share CFD, the cost that you would incur is the swap, the 50 cents. And for the shares, the underlying shares, the cost that you would incur is the $22 commission. Okay, so after that, if we take the profit and loss minus the cost, we have the net profit of, you see the share CFD, the net profit 199, while the underlying shares is like 178 lah. Okay, so but it is also because on here you will see that trading share CFD is cheaper. You end up with a net profit that is higher, but do bear in mind that they are for different purposes. For underlying shares, it is more for a longer term. So if you can hold it for 1 year, 2 year, you don't incur any holding cost. But for share CFD, the longer you hold, your holding costs actually would accumulate. Okay, so that is one downside for share CFD. So depending on your investment objective, you'd be looking into either the CFD or the underlying shares. Okay, so I think that is the illustration of the stocks and stocks CFD. So the final part, I think, which is also a relatively important part, which is to demonstrate to you how do you go around navigating the platform to do a CFD trade. Okay, hold on, let me switch my sharing to the trading platform. All right, so this is the Phillip MetaTrader 5 trading platform. This trading platform allows trading for Forex as well as CFD, as well as a bullion like gold and silver lah. So when after you download, request the demo, or you open an account, you will receive a set of instructions, simple instructions to download this MetaTrader 5 platform and to log into the Phillip Futures server. Okay, so how do we navigate through this platform? I think in the beginning it may seem a bit intimidating, like what are all these? It looks so complex. But trust me, as you know what each of these panels mean, right? It is not as difficult as we thought. Okay, so let's start with this Market Watch panel. So each of these panels are what we call. So the first is the Market Watch panel here on the left side. So this is where you would see all the contracts that you have open. What is the bid price? What is the ask price? You can also configure to see more information like the daily change of price. Okay, so this is where you see the products. Okay, so apart from this, right, like how do you find or what can I trade on this Phillip MetaTrader 5? There are a few ways to see what you can trade. The first is going up to this symbol list here, this button up here, right? You click on it. It will show you a full list of products that you can trade on this platform. See, like I mentioned with Forex right here. So you will see the whole list of the Forex. And we also have CFDs. So CFDs, we cover a few asset classes, as you can see from here. Okay, so for share CFD, we have share CFD from various exchanges, SGX, NYSE, and Hong Kong Exchange. Okay, so this is where you see where to find the contracts that is available. Okay, so to read more into each of these contracts, you can click on it here, and you would be able to see the contract size, like I mentioned just now. You see contract size, it means when you trade one, it means that you're trading one contract. Okay, you would also see things like, in initial margin. To start a position in this, what is the initial margin, how much you need to outlay, and other things also include like what is the minimum volume. So for like the SGX shares on MT5, you can trade as little as one share. So be it just a few dollars, you can start trading just one share with initial margin from 50 cents. You can go as low as that. Okay, so from here we can also see what is the swap that you would incur. The swap here, you can see swap long and swap short. The swap long means that this is the swap that you would incur when you go into a long position. So how to determine the dollar value of the swap that you would be paying is taking this swap long minus 2 times the tick value. Okay, so we have the 0.0001 times, let's say 2. Okay, so it's really just a very, very small amount. Okay, you could do that calculation on your own. So that is some few main functions or few main specs that you can see of each contract. Okay, so now that you know where to find the contracts and you would want to pull out a chart. So let's say we talk about Tesla a lot. We want to pull the Tesla. So if you want to see the chart, right, you simply click on it, drag and drop. So you drag and drop, therefore your chart will appear on this chart panel. You see this whole gray area is a chart panel. You can enlarge your chart right here, okay? So there are many things that you can do to your chart. Firstly, we can change the appearance of the chart. All right, to do that, simply do a right click. Okay, right click, you do a right click, go all the way down here to properties, and you'll be able to choose the color scheme of your chart. So let's say here we want to see it on color on white, which is what we are more familiar with. And there are many functions you can explore on your own, but mainly today we want to change the color. See the color. Also, what you can do a chart is to change the time frame, which we can see here. We have the 1 minute chart, 5 minute chart, 1 hour chart, a daily chart. Okay, so essentially what it means is that on the 4-hourly chart, every candle represents 4 hours. Okay, so maybe let's try with the 1 hour chart. You can zoom in up here, zoom out, or zoom in. Okay, so this is the chart. Right. So now that you've pulled a chart, so what happens when you want to experiment around with the technical analysis that we've just gone through? Okay, technical analysis. So drawing lines is very important in technical analysis. So up here, you get to choose a series of actions. So let's say you want to draw a line, draw a trend line. You click on this button up here. Click on it. Then you can simply drag and drop. So let's say I'm trying to find a resistance line here. From here, I think we can identify a resistance line up here. It takes a few maneuver to get it right. Okay, so let's say here we get the resistance, something like that. Okay, so we get 3 picks here. This is a resistance. Okay, so what about to complete it with another support line? It's the same function, then you can draw a line here. Excuse me. Okay, so right here, what we have here is a falling wedge. The lower lines, the lower lows, they connect to a line. The lower highs, they connect to a line. So, and they are slowly converging. So this is a falling wedge pattern. Okay, so normally once they break out from here, right, it will signal that there's a chance that it will go up as high as the peak here. So that is an example of how you can draw on your chart. Okay, you can also do things like put in a horizontal line to, let's say, or the support level and all that. So that is for you to explore. There are quite a few functions to play with. Okay, so let's say if you want to measure in the event that the price breaks from here to up here, you want to know how many percent is that going to be, how big of a profit that's going to be. Then you will utilize this function up here on the top left corner. It's called the crosshair. You click on the crosshair, you go to the current price, you drag it up to this portion here. Okay, so you can see it shows there that the gain is almost 20%. Okay, so you drag from here to here, you would know that if you enter a long trade here and if the price goes to this level, your gain is 20%. Okay, so that is how you use some of the tools. And apart from that, there's things called the technical indicators. Right, I didn't get to go through that later, but I'll just demonstrate briefly. You can insert this kind of indicators by going up here, like insert indicators. So some of the popular technical indicators out there, they're like the relative strength index, the moving average, convergence, divergence. But now I've just pulled out this relative strength index. So essentially what these technical indicators, I mean, you should also read about all these. These are also part and parcel in your TA. So what RSI generally tells us is when the price is above 70, it means that it is overbought. Okay, it's like overbought already, it's overvalued, therefore the price would tend to come down. And when the price is below the 30, it signals oversold. So you see right here, the price was under the 30. So this means that it is oversold. So that's why it rebounded off here. Okay, but all these, like the technical indicators, it shouldn't be used like alone. Like you shouldn't be looking at these technical indicators, RSI, when it's below 30, then you buy. So it doesn't work like that. You need to form confluence. You need to look at the chart patterns. Is it at a particular support level, resistance level? Pair that together with different indicators, then you come out with a result or a call on your, like, to what direction that you want to take the trade. Okay, so there's an example of a trading indicator. So let's say what happens if you want to place a trade. So for right now, Tesla, we couldn't place a trade because the market is not open. So let's we take the UK oil. Okay, so I think this one we can currently trade. So on here, right, if you want to place a trade, you can just double click on this. Okay, so you can see you can input your volume here, your stop loss level here, your take profit level here. And if you want to buy, you can just click buy. Okay, so that is how you place a trade. Okay, so you want to pull that. So from here, you can see that you've actually placed a trade lah. But once again, this is just an illustration. It's arbitrary. It's arbitrary. I'm not saying that you should buy in this position. This is just for illustration now. Okay, so you can see now, see this dotted line. It is your entry price. So one cool feature is that you can modify your trade by putting in stop loss level or take profit level just by dragging it. So what happens if you want to place a stop loss level? So this is long position. The stop loss level should be below. You can just hover your cursor over it. You drag it down. Then you are modifying your trade order to stop loss. So stop loss is a risk management tool where when the price goes below this level, you want to stop your loss, you want to realize a profit, you don't want it to go deeper, so forcing your account into forced liquidation. Okay, so this is a stop loss mechanism that you should, in your trades, you should practice this. Like, it's very important. Okay, so this navigator pane is where you will see your account. So currently I'm connected to Phillip Futures account. Okay, and we have a few trading tools for Phillip MT5. Once you have downloaded them, your trading tools will also appear in this navigator panel. Okay, so I think that would be all for my platform walkthrough, because I think we are almost time. So to wrap up the presentation, let me go back to the slides. So once again, I think due to the time constraint, I did my best, to explain it in a reasonable pace so that you guys could understand the key concepts. Okay, so next up, what is next? I would encourage you guys to join the next session, which would be happening next Thursday. Bring your friends along. If you haven't signed up for the next session, you can scan on this QR code. In the next session, we will talk about what is the trading plan, what are some of the risk management measures that we should use, and also some post-trade management tips and tricks lah. Okay, so I think now that you have attended the first and the second session, it is also important to complete your learning with how you can put all this into good use and formulate a trading plan so that it works. Okay, so I think this last session, it kind of gels everything together. And also, if you'd like to download the platform demo that I just demonstrated just now, you can scan on this link and you should fill a few information and you should receive the instructions to download the platform. Okay, so it would be great lah if you could download and try it out before you attend the final session of this CFD Discovery. Okay, in case you are interested to start trading, open a live account. You can scan on this QR code. Basically, Phillip Futures, we offer two trading platforms, MT5, which we spoke about just now, and also Phillip Nova, which offers trading for actual stocks, in underlying stocks. Okay, by scanning this same link, you would be able to select which platform that you want. Okay, so I think I've spoke about this Telegram channel, but I think all in all, some closing remarks is that thank you for joining us. In case if you want to speak directly to us, you can feel free to email us, direct it to myself, and we could do a one-on-one call with you to explain on any questions that you have, or even to guide you through the platform. Okay, so I think let me see if there's any questions right here. Okay, but I think for any questions that we identify, I don't think we are able to go through right now, but I'm seeing some questions saying that when will the recording be sent? It will be sent within 3 days to you, to your email, and pertaining to any other questions that I don't have the time to cover, we would also go through like in the email follow-up. Okay, so all in all, thank you very much for joining. I definitely hope the session was beneficial to you, in understanding CFD a little bit better. Okay, so see you guys next week. Thank you very much and have a nice day ahead.